I'm just plugging my mic in. All right, guys. Let me know. You should be able to hear the music. Let me know if you can. Again, the FOMC rate hike decisions today. Let's see what we got. So again, the plan today is almost certainly a pause. We're almost certainly going to pause or skip today. It's unlikely that we're going to raise rates. Market ripped up, pulled back, very green on the day though, at about $420 a share. And again, slap the like button while you're here. We appreciate it. Again, we're going to stream the entire press conference as well as the rate hike decision. The rate hike decision happens at 2 p.m. And so after that, the press conference is going to start at 2:30. Again, will Powell have a hawkish or dovish economic stance today? Let me know what you guys think. We're going to ask the same thing on our poll today. Will Powell have a dovish or hawkish stance? I'll have a dovish or hawkish stance on economic policy today. We're going to do a poll. Dovish, hawkish. Vote on that poll. We appreciate it. I already got 100 people here in about like 2 minutes. Yeah, the speech is live. So the speech is live. So again, I always try to show people this, but the Fed raises rates to discourage spending, right? Usually they're more aggressive in times of high inflation and high inflation fears, which I would consider the last year or two that. I think the market has certainly feared inflation over the last year or two, and we've had some pretty aggressive rate hikes as well as some pretty bad inflation overall for the last 2 years, really. Essentially since the 2020 problems, and then a lot of this started back in 2020 when we had the pandemic, everybody was home, they definitely started quantitative easing, and just a lot of stuff happened over the next few years. With all that said, the Fed raises rates to discourage spending to help combat inflation. The process of it is they raise the federal funds rate. That makes banking more expensive. When it's more expensive for banks, they raise interest rates to consumers, which discourages spending because when interest rates are high, less people want to buy. And so by discouraging that spending, consumers stop spending as much, and then businesses must in turn lower pricing to compensate for it, thus combating inflation. That's the procedure of it. That's why they do it. That's how it raises interest rates and discourages spending. And that's the whole point of, the Fed raising rates aggressively. Last Fed meeting, they make that decision on how much they want to raise or lower rates or pause, which is what we're currently in now, every 6 weeks. That's what this FOMC meeting is every 6 weeks they make this decision. And the decision drops at 2 p.m. Eastern Standard Time, followed by the press conference at 2:30 with Powell. And, almost everybody is expecting a pause or skip today. It's pretty certain that that's what's going to happen. It's not completely certain, but it's pretty certain. If he, for whatever reason, decides to go against that expectation, which is about 97% expected to pause, again, as we paused this last cycle, it's not a skip because we're not skipping a rate hike and coming back to one this time. We paused on the last meeting as well. But anyways, if he shocks people and raises rates, the market's almost certainly going to react negatively, more so than anything because it's a negative inflation sign. Like, it's a bad inflation sign. If the Fed is worried about inflation, they're going to raise rates, and that's a bad sign towards future outlook on inflation, because the Fed definitely has some knowledge that we don't know, as well as what's going to matter more so if we come in as expected, which is pretty likely, is what Powell says during the press conference. That's why my question today is: Will Powell be dovish or hawkish today? Because that's what's going to influence the market really heavily. Is what Powell chooses to do during that. Yeah, it's pretty low right now. Let me see what the CME. You can always check to see what the probabilities are for a potential rate hike on the CME Fed Watch tool. You can see that right here. 98.8%, so 1.2% chance that we're not going to pause or skip. Only about a 1.2% chance that we're going to cut rates is what this actually shows right now. I thought it was different this morning. It was actually backwards to this morning, but now I guess they're having another. Right now we're at 525 to 50. Basically, they're expecting a 25 basis point cut right now at 1.2%. But it's very likely, again, 99% basically that we're going to pause today, that we're not going to raise rates, that we're going to keep it at 925 to 950. Just very likely at this point in time. Wait, so can someone explain to me what's about to happen and what can affect the market? I think I just did, right? I mean, let me know if everything I said makes sense. That's basically what's going on right now, is that the Fed's going to make their rate hike decision on whether they want to raise the federal funds rate, or they're almost certainly just not going to do anything. They're going to continue to pause rate hikes for now. They said they might do 4 cycles or a couple cycles ago. So we only have today's FOMC decision and then one in December left for this year. And they did say that they were probably going to raise rates one more time. And so, but if they're more optimistic regarding the economy, they could go against that or change their plan. That's not uncommon for the Fed to change their plan and be less hawkish than expected. So, okay, all good. Why is Tesla crushing? Let me look at Tesla here. So Tesla is pretty flat right now. I mean, it looks pretty sideways. It dipped down today for sure, but it's still technically green on the day. So again, if you look at this previous closing price, it's right around the 200 EMA, right around 200.84. So we're basically holding right above that, but we're technically green. Above this light blue line here is the previous close yesterday. So we're technically green over the last 24 hours, basically, is what it's saying. So Tesla looks okay. We got some other stocks that we could look at as well. Again, the market's pretty flat. The SPY had a pretty good open, pretty good comeback. We were all the way down here, earlier this morning, and we fought our way back and broke over that previous closing price. And now we've essentially been consolidating since, noon market time, a little bit past noon market time, under the 200 EMA VWAP for a little bit. And now we're back testing this high again. So, another one to watch, I think, today is NVIDIA. NVIDIA had a pretty good day, back up to 417s. AMD had earnings yesterday and then ran a lot today after earnings, shooting up a lot. You can see it's all the way at 107s right now, basically 107s for AMD. We've also had some earnings drop, and then tomorrow we have Apple earnings, which is a pretty big, release as well that you certainly want to pay attention to. So let me do my Twitter poll. I think I forgot to do it. Not a lot of negative action out on all right. All right, so Powell hawkish or dovish today is what we're going to do on Twitter. All right, team. Slap that like button. We appreciate it as well. Looks like a trap, maybe. We'll see. All right, so SPY over the volume weighted average price. So we are now over the volume weighted average price. My bad, guys. I got sun in my eyes right now. Yeah, if he surprises with 25 basis points, it's going to shock the system. It's just the problem is that's just incredibly unlikely. Why is a pause expected? The Fed to probably need one hike and have 2 meetings left this year? Because the Fed changes their tune a lot. So the Fed will kind of go back on what they say and like change their tune really heavily. You see it happen like a lot. And so the Fed will kind of surprise people and go against what they said. Sorry, I got some sun in my eyes right now. Yeah, let me get a timer. My bad, guys. Here, hold on. Oh, we got 44 and a half minutes, really. Timer for a minute before the meeting or the decision at about 2 o'clock market time. SPY still over 420 at 420.22. Where's the sun coming from? Oh, I see where the sun's coming from. It's coming from a different side. Hold on one second, guys. All right, guys, bear with me 1 second. I'm trying to get this. Thanks for the update on the FOMC. I'm on my lunch break, but once I get back around, I can have this in the background coming in clutch. Hey, no worries, man. They're definitely not going to raise Gonzalez. Everybody thinks they will, but then they never do. So incredibly unlikely that the Fed chooses to raise rates today. It's incredibly unlikely. Again, every time we stream the FOMC meeting, we always have a lot of people that bet on like a surprise, and it never happens. And then the market usually ends up doing the other thing. So. All right, so I basically just blocked a lot of the sun. There we go, that's much better. All right, yeah, again, we'll see. We're testing the VWAP now for the SPY. So we're testing that level now, and this should jolt the markets. We'll see, though. We still got 45, or we still got a minute before this drops, so be ready, guys. That's what they said the last time, and boom, we got a rise. No, we didn't. Last time we paused. We paused or skipped or whatever you want to call it. John Krasinski? You think I look like Jim from The Office, bro? My family would celebrate, honestly. Like, my family's a big Office family. I used to hate it. Like, when I met my wife, I hated The Office. Like, it was very dry humor. You know, I just didn't really get it. And then Carol forced me to watch it in pieces, in chunks. And then after a few years of it, now I know every episode. We've watched every episode. And it's kind of like my comfort show now, but yeah. I've heard I look like a lot of different people. That's the first time I've heard Jim from The Office, though. You look like Karate Kid, Ralph Macchio. Eh. To be honest, race, skip its extra, doesn't matter. Market moves on its own mind. Yeah, for sure. I mean, but usually, again, I cover all these FOMC meetings. right? Like, again, people could say we're gonna surprise and do what's only about 1 point whatever percent chance that we're gonna happen, and maybe it does happen. Again, I'm not saying it doesn't. What I'm saying though with FOMC meetings is that you don't want to bet on the 1% chance, even if it happens, right? Like, it's just a risky bet going against 99% of analysts in the world. I think it's a very risky thing. And again, considering the fact that I stream every major FOMC meeting, almost always it's as expected. I'm not saying there's never been shocks to the system, and I'm sure there will be, and maybe today's that day. Again, I really don't know. What I'm saying is that betting against that and really pushing that is something that I've seen a lot of people do every rate hike decision over the last year straight, and they've been wrong every time so far. And so I'm not saying we don't do it this time. I'm saying historically they're about 0-9 for me over the last year and a half. Mr. Miyagi, hey, the GOAT. Yeah, I don't know. We'll see. All right, so again, SPY under 420, testing that 419.90s level. AMD at 107s. We'll see if it hits that spot too. It's got some room, but it's tested that 107 line a couple times. The reason I'm looking at AMD is because it's a big influence on everything else. Tesla as well today, kind of sideways neutral, pretty flat on the day. Red since the open, but was green in pre-market before the open anyway, so it's kind of flat now. Microsoft had a really good day. If you look at Microsoft, it's up a lot today, as well as, again, NVIDIA shooting up today. Apple, another big one that had its event earlier this week, is up a lot as well. I think the event was, yesterday? So we're green on Apple, green on Microsoft. Yeah, hit the like button, guys. We appreciate it. No, I mean, would you be closing out all open positions before 2? No, not personally. But a lot of these positions are long term. Like, they're not short term positions. So this happens every 6 weeks, and so I'm not going to close out all my investments every 6 weeks. You know what I mean? All right, so we got the poll on Twitter. 70% of people basically are hawkish on this meeting. 30% are dovish. We'll see. According to Wells Fargo, they think the housing market is heading back to a 1980s style recession. The government just arrested SafeMoon founders Johnny Caroni, Kyle Nagy, and Thomas Smith. Raiders fired coach Josh McDaniels. What are the Raiders' record this year? 3-5. They're not doing that much worse than my Saints. SPY's starting to flush down, but again, we're pretty sideways here since we've been mostly sideways since noon, a little bit after noon. Apple pushing up some. They'll say 2% target inflation is still elevated, Yeah, that's basically what they say every time. Raz, 100%. I agree. That's what they say every time. Again, if you don't know how to look this up, right, I'll even show you guys how to look it up. Again, to look this up. Okay, so again, right now we're at 525 to 550. You can see the last statement here was from September 20th. That's when the last meeting was, right? So and so this next one will be right here, basically November 1st, right here. You'll click HTML, and then you'll scroll down and you'll look here. So right now we're at 525 to 550. So 5.25 to 5.5 is, you know, fractional expression of that. And so you'll basically look down here. If it's a pause, it'll say this again. So if it's a pause, it'll say 5.25 to 5.5%, which is 525 to 550. As well as if it's a rate hike, it'll say 550 to 575 or 5.75. If it's a cut, it'll say 5 to 5.25. You know, so that's what we'll know what the decision is right at 2 p.m. on the dot. And then the press conference will stream live here as well. We always do. If I'm bullish, I would sell 50%. Don't be greedy. I'm bearish today. Hey, good luck. Sell the news. I really don't know. I believe they'll skip, but be hawkish in the speech. Maybe, Chris, for sure. I mean, that's possible. Long and short NVIDIA. Yeah, this is more like 90s cool jazz in the morning. You know, it was a really interesting time in the 90s. I remember like going to bookstores and they would have like headphones, right? They would have like headphones that you could go in there and like listen to different albums. And I remember listening to the jazz album a lot and like Barnes & Noble or Books A Million. I can't remember what bookstores they were. They don't have that anymore because technology has evolved past that, but that's what this song reminds me of. If the video's lagging, Ja, it's on your end, man. Did you make a couple thousand today? No. I wish I did. In futures, I'm up like 530. Stocks, I'm down a little bit. I think my portfolio's down like $100, which is pretty flat. I mean, I have a $40,000 portfolio, so $100 is pretty small. You know, the market's probably pretty flat ahead of the FOMC meeting. Doing good, hoping the Fed has some sympathy for my puts. We'll see, man. Blockbuster Video. Blockbuster Video was awesome. I like Blockbuster, man. You had a finite amount of DVDs they had available for rent, and so you'd always go there hoping you could get one movie, but it was never available, so you ended up picking some like obscure movie that nobody's ever seen before, but in certain ways it was better anyways, because you got a surprise in terms of what you were watching. Broadened your taste a little bit, I think. Again, we got 2 minutes before 1:30. The decision drops right at 2 p.m. on the dot. This is the SPY, which is the S&P 500, basically, right here, the SPY. Here's Apple. We can put the Q up. We can look at gold. Gold's been pushing up a lot this week. Q up a lot this morning. Bitcoin's still sitting at just under 35K. Gold is down a little bit on the day, still right under 2,000. It's at 1987 an ounce. What's your personal bet? I'm going to go with dovish. The reason I'm going to go with dovish is because they try to be balanced. And they've been kind of hawkish lately. Although I'm trying to remember what we did during the last Fed meeting. I believe that we were hawkish again the last Fed meeting, but we might have pushed up as well. I'm not sure. I'll have to go back and see. When was the last Fed meeting? It was September 20th. Okay, so let's go back and see what the market did on September 20th. Let's put a 15-day chart up. All right, so that's August 20th. We need September. September 20th is right here. So yeah, it looks like we had bearish reactions last. Yeah, so here was the last meeting, right? So the last meeting tanked the market basically. So 2 p.m. is right here, right? So here's 2 p.m. And you can see starting then we had pretty bearish action after the last FOMC meeting, which was, again, a pause or a skip. We didn't raise rates during the last meeting. It was a pause or a skip. So again, interesting to see what we're going to do here. A lot of the time they're balanced. Again, if we're skipping today, I think but there's also a chance that we're going to cut rates. Again, it's a small chance. It's like 1.2% the last time I looked, and we can look at it again. But there's a small chance that we're going to cut rates, which, again, I think is very unlikely. But if we do, even if we don't, maybe that's an optimistic sign. Okay, now we're back up to, maybe I just had to refresh the screen. Okay, so now we're back up to 0.8% chance of a rate hike. So maybe I just had to refresh the screen early. I'm not sure. 99.2% chance of a pause or skip, which is very likely. 0.8% chance of a 25 basis point hike to 5.5 to 5 3/4. So again, we'll see. Market's pretty flat ahead of this. A lot of the time, the market's pretty sideways leading up to this report. We can look at the Q as well. This week's been pretty good on the Q, but the weeks preceding this were not. Although today's pretty solid. Q back up to 350s. Again, you can take a look at like Apple. One of the weak stocks has been Tesla. Lately, Tesla has some pretty big pullbacks over the last, couple weeks, 3 weeks. So again, we'll see what happens. Tesla right at 200s. I think, again, we're almost certainly going to pause today. It's almost certain that we're not going to raise rates. We're not going to cut rates. We're almost certainly going to pause and keep it business as usual. And then what matters more than anything else, if we do as expected, which is a pause, is what Powell says during the actual press conference. So whether Powell thinks we're going to raise rates in December, that's one thing that you want to pay attention to if you're actually listening to this meeting, is whether Powell is going to want to raise rates in December. That's a very important thing that you do want to keep your eye on, is how many rate hikes, what's the plan for the rest of the year, as well as early 2024. In the following meeting, I believe the next one will be in February. What's Powell going to do then? Is Powell going to want to raise rates then? Is his plan to completely, indefinitely pause in rate hikes and keep everything dovish moving forward and stop the aggressive rate hike decisions? Or are we going to fear inflation more? And is inflation going to continue to rise relative to CPI, PCE inflation data, and all the other economic inflation reports that we get monthly? I'm not sure. Again, we'll see. Chat, let me know what you think. Yeah, trade. Stop spamming nonsense, dude. Energy prices are high in winter, so I don't think Powell will raise in December. Yeah, maybe. Bitcoin seems bearish short term. I mean, it ripped up to 35K earlier. I don't remember what the news was of the rip, but it ripped up to like 35.6K earlier. Powell will raise in December. Things have not pulled it back enough, and inflation is sitting around 20+% right now, and not 7% like they're saying. Maybe, but it depends on which inflation you're referencing, whether you're talking about core inflation, whether you're talking about excluding food and energy. Market dip during speech, maybe. Again, we'll see. Forgot all about eBay. We also have some earnings today. We got Roku and PayPal earnings after the closing bell today. So we do have some earnings that are getting released too. Again, PayPal sitting at 51.25s. I think people are underestimating the downside. I think the downside is usually overestimated based off of my viewers. And again, I'm not saying we don't dip, but I think market crashes are overpredicted from my experience. There's a lot of reasons why, but I think a lot of people are overestimating crashes because of bias, political bias, maybe. But again, maybe we do crash. I'm not saying we don't. A lot of people have been calling for a real estate crash. And again, after Keller Williams and the National Association of Realtors recently was sued because of alleged collusion and commission rates, right? And again, I know one of the rules here in Texas is that you cannot have a standard set commission rate. I would say on average, most people go with 3%, but again, it's completely negotiable and you're not actually allowed to say or build a monopoly around a certain commission rate, if that makes sense, right? And what the National Association of Realtors, as well as Keller Williams and one other real estate company or body, they basically were charged with colluding to set commission rates. Right, they got to pay a fine of $1.8 billion. Real estate overall has had a really big pullback, over the last 24 hours from this. If you look at like Zillow as an example, right? Zillow, one of the bigger real estate stocks, Redfin as well. Zillow absolutely dumped when this news came out. Look at this huge drop from like, $39 a share down to 35. It basically dropped almost $5 a share. Looks like 4.5, 425, 450 a share. So that's a very big drop. Very big drop, over 10% drop. And yeah, again, the real estate market might follow it. We'll see. You can look at like Redfin as well, which had a pretty big drop from $5 down to $4. So about a 20% drop there. Standard commission rate would be constitutional equal treatment. Yeah, but a lot of stuff in real estate is negotiable, right? So a lot of real estate stuff is negotiable. And I think that's the point, is that you have to give buyers and sellers the freedom to negotiate commission rates. You cannot set a commission rate high and collude to keep it high like that, because you want people to get paid more and you get paid more. So and so that's the rule. And again, I don't know whether they broke it or not. It's all alleged. I don't really know, but I know they got sued and they lost the lawsuit, 1.8 billion. You can look at like the Vanguard. What's the Vanguard real estate one? I know it's like V something. I'll have to remember it. Chat will probably help me out here. If it's bad news, we might drop the S&P 100 points. I mean, maybe. I love Powell. No chance to hike. Yeah, I mean, we're not going to hike. I mean, it's just super unlikely that we hike. We could. It's just unlikely. Again, SPY pretty flat. We can look at like the Q. Looking at our poll numbers here. 427 votes already. 48% are dovish, 52% are hawkish. So anyone here brave enough to hold a NASDAQ or E-mini position through the announcement? Not necessarily me. I mean, I'm holding a SPY position, but it's a longer term SPY position. So, all right, guys, we still got 20 plus minutes, 20 something minutes until we get the actual sorry. I got so many monitors here. ADHD gets a hold of me. I don't do single stocks. What's up with Zillow? Did you hear anything I just said, Straight Jacket? I just explained. So with Zillow, again, the real estate market is reacting very negatively after the National Association of Realtors, as well as Keller Williams and somebody else, lost a lawsuit for about $1.8 billion with the charges of collusion to keep interest or to keep commission rates high. Is what the charge was, right? That has tanked a lot of real estate stocks, including Zillow, Redfin. Happened yesterday afternoon. Looks like the news came out at about 1:30 market time yesterday. Yeah, we'll see if Powell's peaceful today or not. I hope he is, but we never know. 23% is aggregated over 3 years. Inflation was 9% a couple of years ago. Yeah, it was close to 9. It was like 8 point something. Pretty close to it. Again, we stream all of this stuff, and we've been covering it for years too. It's settled down a lot though over the last like year and a half. And you've seen it in like gas prices is a great gauge of it. A lot of people like core inflation, the core CPI, core PCE, to gauge it because that excludes food and energy. But I think food and energy are some of our major purchases. And I think you have to understand that you have to understand that ultimately, we'll see what we have. We'll see what we get today for a rate hike decision. And yeah, I think. Here, sorry, somebody's messaging me. I think we have to look at gas prices specifically to gauge it. Gas prices have gone down a lot since over the last year and a half. If his tie is red, we're doomed. Maybe, bro. Maybe. Well, groceries are expensive and gas prices are up a lot, but yeah, we could look at bonds today. Bonds, we had the Treasury adjustment today. If you look at bonds, TLT spiked up big. It's holding okay. The 10-year is down a lot. It's at about 4.8%, but the 10-year is still up a lot over the last 20 days. I mean, here's a 20-day chart on the 10-year, so it's neutral. But here's a yearly chart. The 10-year on the year is up a lot as well. You know, at the beginning of the year, about 52 weeks ago, at least not the beginning of this year, but about 52 weeks ago, it was at about 4%. We're almost up to 5 now. We're at 4.8. Yeah, so the current average for Texas gas prices in my area for regular gas is about $2.90. All right. Gas prices are down drastically. Now, maybe where y'all are from, that's different. But again, I know a year and a half ago, it was $7 a gallon. You know, 6 something, 5 something, 6 something, $7 a gallon. So they've dropped, you know, in a lot of places over 50%. So yeah, I mean, again, it's purely just my area that I'm looking at. But when I look around, gas prices have gone down pretty heavily. Gold buy or sell? I don't know. Gold's ripped up a lot. You know, gold's had a pretty big move over. You know, gold's had a pretty big move this week. It broke over 2,000 for a second. If you look at a 20-day chart on gold, right? So here's a yearly chart on gold, right? A 20-day chart gives you a really good understanding. We've pushed up a lot in gold over the last 20 days, over the last 3 weeks or so. If you look at a 6-month chart, we're kind of flat, but we were really low. Gold had dropped to one of its lowest levels in a while, back down here at this 1800s level, and then bounced all the way back to basically 2000 over the last 3 weeks or so. So gold's had a nice little comeback the last 3 weeks, but today it's slumping down, but it's pretty flat as well. SPY is very neutral, testing the 200 EMA, trying to fight its way over the volume weighted average price. $18 minutes. Yeah, for sure. Again, hit that like button, guys. We got 83 likes. Come on now, guys. We can do better than that. We got about 500 plus votes. 53% of people are hawkish on Twitter or on YouTube. So 53% are hawkish, but pretty split down the middle. If we look at YouTube, or if we look at Twitter, I mean, 67% are hawkish. It's gone down a little bit, but still a majority hawkish traders on this today's speech with Powell. And again, at 2:30, we're going to do the press conference. That's where the Q&A is. That's where Powell's going to give his stance. That's where we're going to get a lot of that information. But at 2 p.m., they're going to announce, almost certainly going to announce a pause in rate hikes. They're going to keep it at 5.25 to 5.50, you know, 5.25 to 5.5, where we're at now. And again, we'll see what happens. Again, the way you look at it is here, you know, and the Fed minutes report will be out in a couple weeks too. But this one will be right here. So again, we got 2 more rate hikes. We got October, December. Then we got November 1st, which is today. And then we have December 12th to 13th. So mid-December, we're going to get our next decision here. And so hypothetically, if we do pause today, which is pretty likely, again, what you want to pay attention to in this next press conference is what Powell says about next December 12th, December 13th, actually, is when the press conference is going to be. What Powell says regarding that specific decision, you know, whether he thinks that they're going to go with their previous plan, which is something he's been very clear about, which is that his plan was to have 1 more rate hike this year. But he said that a couple cycles ago. And so that's what you want to pay attention to, is whether Powell thinks that we're going to raise rates in December, and that's assuming that we again pause today, which is pretty likely. The other thing to listen to is what Powell thinks regarding a potential recession sometime soon, whether it's early next year, mid next year, late next year, late 24. A lot of people think, and correctly so, I would assume, that these rate hikes are going to start taking a toll, a little bit of a delayed effect as they are next year. So a lot of people are thinking that we might hit a mini recession next year, maybe a full-on recession. And so what Powell says regarding potential inflation or potential recession implications is important to pay attention to. The other thing is, again, what we plan to do for rate hike decisions next year as well, what the current state of economics looks like, when we think we're going to be able to hit the 2% goal, which I think the last time he spoke, the last Powell press conference, he said that he thought that we'd be able to hit the 2% goal. I think he said 2026, so a few years from now still, before he thinks we're going to be able to hit 2%. But if that changes, that might influence the market short term as well. So those are all things that you want to kind of follow, buzzwords that you want to pay attention to and listen to moving forward. Yeah, maybe. Again, do you think we're headed a recession this year? Let me know. All right. Again, the FOMC rate decision. All right, so again, we're going to put this up. The FOMC rate hike decision is going to happen right here at 2 p.m. The full conference will then be streamed live here at 2:30 Eastern time. So again, that's what we got going on right now. Still got a few minutes before the actual decision. We got about 700 people here. They want a recession. We will have a recession. A depression is bearish. Maybe. Yeah, I hope we don't hit a depression for sure. Rate pause with hawkish statement. Yeah, maybe. We'll see. Bears in chat. Yeah, it's pretty standard, I would say. Don't know, my gut feeling tells me we're dropping big. Yeah, I mean, you had that gut feeling the day before yesterday, Ramsey. How'd that turn out, brother? I'm not saying you're wrong here. I agree with you a little bit more today. I think if we're going to have a big, crazy drop, it's going to be today. It's going to be some big economic event and decision that's going to cause a big, crazy drop. It's not going to be just a random day. Fed doesn't really care about stock market, cares more about bonds, economics. Yeah, I mean, we cover bonds as well. Again, if you look at bonds right now, the 10 years down, 20-year up, but it's going to be a pause, but they won't do a pause without also having a hawkish statement. Yeah, for sure. Again, Bitcoin at 34,875. Gold still trying. I'm a bear, but I identify. Hey, do your thing, bro. I'm a bullish trader, but it might be just confirmation bias. Like, I want the market to go up, and so I hope it does, and maybe I overestimate it going up. I just know the biggest, most profound edge the market ever gives you is that it's going to go up long term, and a lot of people miss out on that edge chasing short-term stuff. Are there any leading economic indicators showing a better 24 than 23? I don't think so. Yeah, but at the same time, it's also a little early to tell. I mean, we can look at it and try to gauge when we're going to see inflation. If the Fed thinks we're going to continue to show damage to inflation over the next year, that's optimistic, I would say, but you never really know. And again, only time will tell. We can only try to predict and speculate on it. All right, team. Again, market is very flat, very sideways. We can look at this range to see if, we're almost certainly going to break out of this range, but you can kind of see the flat, choppy action in the market right now. We can go up and down, up and down. What other chart do you want up? I'm going to have the SPY up for sure. But do y'all want gold? We could have bonds up. We could have the dollar index. We could have the 10-year, the 20-year. You know, what do you guys want up on the chart? We could have gold, Bitcoin. Vote in that right now. What do you guys want on the chart? Let me know. On the right side, we're going to keep the SPY on the left. We can also put the Q, you know, the NASDAQ futures contracts. There's a lot of different options here. Just let me know what you want. We got 11 minutes or so, or 10 minutes or so until this drops. 10-year gold, UVIX, volatility ETF. Please don't say the same thing over and over again. PRA. Gold, feet picks. Okay, maybe. AMD, beast mode. Yeah, AMD's had a great day today for sure. AMD's flown up. Thoughts on Palantir, DraftKings gonna blow out earnings, NASDAQ, SPY, gold. Well, SPY's gonna stay up, so we don't need to eat many because the SPY's up. Is the music up too loud? Here, I'll lower it a little bit. Tesla, you can keep Tesla up. Yeah, we got it. You said gold, or praying, or whatever you're. Gold, Bitcoin, Dixie, United Health, Bitcoin. So far, gold wins, I think. Here's gold right here on the right. I think bonds might be interesting to see what like the 10 or 20-year yield does. Q. All right, team. %12 of Generation Z say they believe they'll never be able to own a home. Zoomers? What is the... All right, so Generation Z is 97 to 2012 born. Yeah, so that's young people. That's like 20-year-olds. I don't know. You just got to work for it. I think anybody can own a home. Whether you're going to own it outright without a mortgage is a different story. All right, team. SPY back over 420s. Again, AMD rip it up. Bitcoin testing 35K right now. SPY over volume weighted average price. 8 minutes. Expecting neutral commentary. Yeah, I mean, we're going to be neutral. Oh, you mean by Powell? Yeah, FOMC in 7 minutes. Again, hit the like button, hit the notification bell. We appreciate the love. Thanks so much. They'll just rerun the last meeting. Hawkish tone, skip, monitor. Yeah, I mean, I think that's probably going to happen. I think they'll be pretty neutral, all things considered. I think we're going to pause, continue the pause, and then, yeah, I mean, I think that's going to happen. Maybe not, though. We got over 1,000 people, though, here. Slap the like button. Subscribe if you haven't yet, team. We appreciate it. Again, the big meeting is going to happen after the press conference. Hey, man, are there speculative forecasts how much the interest rate's going to be? Yeah, it's probably going to pause. It's probably going to stay at, what are we at now? 5 1/4 to 5.5% is almost certainly what it's going to stay at. You know, you can see this here. 5 1/4 to 5.5. Only a 0.8% chance that they're going to raise rates 25 basis points to 5.5 to 5 3/4. So again, only about a 0.8%, less than 1% chance that that's going to happen. It's very certain. It's very probable, at least. I'm not going to say certain, but it's very probable that we are going to pause interest rate hikes continuously. And again, I think I'm going to go with a dovish tone. I'm going to go with dovish. We are in the holiday months. Generally, guidance there looks good for the most part. The market tends to do well, and there's something called a Santa rally that happens a lot of the time. But again, we'll see. You don't really know for sure. Okay, all good. Pew pew. 0.8% gang. Who's in the 0.8% gang here? Do you think they're going to raise rates today? Let us know. And again, if you're right, I'll give you credit. If you're wrong, so many people are going to bet against it anyway. That. So what makes us puke here, even with a pause? him saying inflation is too elevated, him saying that they might potentially raise rates more aggressively in December, him saying they might raise rates aggressively in early January, February, him saying that we're going to hit a deep recession sometime next year, him pushing back the scope of time it's going to take to hit 2% inflation, which I think he predicted 2026 was the last thing he said, 2026. Where if he pushes that back, that's a negative sign that might make some drops happen. And again, we'll see. Pause. It's crazy to raise rates after we have 2 wars. Yeah, the banks are going to struggle if we raise rates. That's the risk, right? Regional banks struggled earlier this year already because of aggressive rate hikes last year. We saw that with the regional bank disaster we had earlier. And so, yeah, that's one of the things. Again, banks are very weak over the last few days as well. Pause doesn't mean market will rally just because rate is high enough. I mean, we'll see. Jolts was pretty bad today. Yeah, Jolts was light. Again, I don't know. Again, we got 4 minutes left, team. 4 minutes left. Yeah, gold is interesting to watch too. Gold's on the right. We can keep an eye on that. We'll see. 5.5 is going to be a pause. Yeah, 5.25 to 5.5 is going to be a pause. 5.5 to 5.75 will be a rate hike. 5 to 5.25 will be a rate cut of 25. So, and again, I don't know if we're going to hit that or not. We'll see, but prepare yourselves. I'm mostly long right now in positions, so I would say I'm mostly long. But again, I got a long-term portfolio. This is a long-term blue chip portfolio mostly. I hold some mid caps, but it's mostly blue chips. And so, I mean, I'm going to be long. I'm not going to short anything long-term. There's not really much available to short long-term, as well as like there's risks in holding short positions that long if they're healthy blue chip companies. Bear. Again, we got over 1,000 votes. 50% are dovish, 50% are hawkish. He does need to raise, but it won't do anything. Big question is, are they done printing money? Yeah, we'll see if quantitative easing is done. I'm not sure. Current rates only seem high now because they were abnormally low for so long, but historically they are in a more normal range right now. Yeah, for sure. Like, I understand that, but regardless of what we have, like over a longer period of time, 8% is very high right now for like mortgage rates, as an example. Like people aren't used to paying 8%, and so when people aren't used to it, as well as people got used to really like low lending, like really cheap lending, they got really used to it, right? And so to a certain extent, they've been conditioned now to only accept really cheap lending. And so when lending is very high, even if it's more conventionally normal right now, when lending is really high, they don't like it, of course, and they freak out, they trip out, they stop buying. We'll never get to 2%. I don't know. We'll see. All right, guys, we got 2 minutes left. 2 minutes. Again, we're going to stream the full rate hike decision as well as the entire press conference at 2:30. So be ready. Again, Bitcoin at 35K roughly, just under 35K. We still got a minute and a half left, guys. A minute and a half left. Yeah, we'll put the whole meeting up. We'll stream the entire thing. Put that up so people understand. All right, guys, we got about a minute left. About a minute. Higher interest rates can make crypto bearish. Crypto is a little bit of a outlier. We don't know what crypto is going to do from all this. It can't. If banks are really weak, crypto can have strength from it. But aside from that, a lot of the time it follows the market. But it certainly depends on how you look at it. All right, guys, 45 seconds. We got about 2,000 people here. So again, slap the like button, hit the subscribe button. I'm also going to throw it in sub-only mode. So if you haven't already subscribed, we appreciate it. We cover all market data for free every week, every day. We give you all this stuff for free. We're going to stream the entire thing live. 30 seconds. 30 seconds. Again, make sure you hit the live button next to the play button. You want your live button to look like this to make sure you're fully caught up. And again, we'll report on it faster than you'll be able to find it. I'll tell you that. Make sure your live button looks like that, though. All right, team, here we go. Ten seconds, guys. 10 seconds. 5 seconds. All right, let's see. All right, watch the market. Watching the market closely. Waiting for it to show. Waiting for it to refresh. Market's moving up so far. I don't think the report has been digested yet. Nothing. Nothing. Refreshing. No movement yet. So far positive. There's the report. The report's live. I'm assuming we paused. Yeah, we paused. Okay, so we paused. They decided to maintain the target rate of the federal funds rate at 5.25% to 5.5%. And so paused. Market's moving up on this report. I told you guys we wouldn't surprise Skip. People are like, this dude doesn't know what he's talking about. Like, bro, it happens every time. Like, I'm not saying like you shouldn't ever bet against it, but it happens every time. So pause continues for rate hikes. All right, FOMC paused rate hike. They did not raise rates. They paused. All right, team. All right, so now we're back down. We're very flat from this report. Again, so the FOMC pause continued. Again, stick around. We are going to stream the entire thing live right here like we always do. So stick around. You won't have to go anywhere. We are going to stream the entire thing live right here. Don't go anywhere. Again, pause. All right, guys. So again, so far, market is slightly reacting bearishly. It's not really a huge bearish response. Relative to everything else, it's pretty flat. And we're back up to over 420 now. So very neutral in this report. What's going to matter more than any of this, guys, as we said, is going to be what Powell chooses to say during the press conference. Like what Powell says is going to be incredibly important. Back up to 420 plus right now, 420 plus. So a big move, a big pop. Again, we got the full meeting going live soon. So stick around, team. We're pretty flat. Gold moved up a little bit with it. Let's see how Bitcoin didn't really do much. Gold ripped up. Bitcoin didn't really do much. Bonds, I'm sure, are pretty flat throughout all this. Yeah, pretty neutral. Down a little bit on the 10-year. The 20 is pretty flat as well. Anything else moving that you guys think I should see? Again, gold up a little bit, but pretty neutral with all this as well. Can you explain what all this means and why is it important? Sure. So, okay. So the FOMC meeting, right, happens every 6 weeks, right? It's where the Fed, and it's not just Powell, but Powell's the chairman. It's where they decide what they want to, do in terms of interest rate decisions. They raise the federal funds rate when inflation is bad, right? And the worse inflation is, the more aggressively they'll raise the federal funds rate. But it's a balancing act because if you raise it too much, you can cause crashes, basically. And so depending on how bad inflation is, the Fed chooses if they want to raise rates. It combats inflation by raising the federal funds rate, which makes it more expensive for banks. And when banking is more expensive, they raise interest rates to consumers, which then stop spending and stop borrowing as much because the interest rates have been risen. As interest rates goes up, consumers stop spending as much. When that happens, businesses lower prices to compensate for it, and thus it combats inflation. Is the cycle. And so in periods of really bad inflation, like we've had over the last few years after the pandemic, the Fed is really aggressive in their rate hikes, and they have been over the last 2 years, really. But lately, they've been pausing or skipping rate hikes, basically not raising rates anymore, potentially not raising rates for the rest of this year. And historically, again, last meeting or a couple meetings ago, Powell said they thought they were going to do 2 more hikes this year, right? And this was with 4 meetings left, and they've done 1 hike so far, right? And so if Powell continues at his plan, in December, we're going to raise rates 25 basis points if that plan continues, but they're always changing their mind. They're always changing it based off of economic reports coming in that influence their decisions in that regard. So they're always changing it. And again, it's very possible that the Fed is optimistic regarding the future in next year and that they choose not to raise rates in December. But they'll give some foresight into that potentially today. And so again, we'll see, but that's basically what's going on. And that's basically what you want to understand. Again, the speech will be streamed here live at 2:30. All right, a very neutral response here from the SPY and gold and everything else. There's gold on the right. Here's the SPY on the left. Again, very neutral response for gold. Very neutral response for Bitcoin. Bond yields are down a little bit from this. You know, the 10 years at about 4.79%, right under 4.8%. Other stuff is reacting in an interesting way. Tesla has mostly been flat. Again, the whole market's waiting on what Powell says today. Today was kind of a neutral report. It was as expected. It was a pause as expected, which is a neutral decision as well. So again, we'll see. Time will tell. And again, we're going to stream the full press conference live right here. We'll get a timer up so you guys can wait on this as well. But again, the full Powell conference is going to be streamed live here in about 23 minutes or so. We'll put that timer up so you guys can see when it starts. Again, we're watching the market's reaction to it. Yes, we got the timer up. 2:30 Eastern Standard Time. Amazon's still cranking up from earnings. Amazon's up a lot. It's at 135s right now. Nice movement. The statement had hawkish and bearish elements. Labor was hawkish, but they mentioned tighter financial conditions for households. Yeah, we dumped down the last FOMC meeting. Last report the market did before the meeting. This time it's sideways and might signal a bullish response. I hope they're dovish and optimistic, but you know, it doesn't necessarily mean they will. See a dentist? My teeth are pretty straight, you know? They're pretty white too. I mean, you know, I got pretty straight teeth. Why signal cuts when job market is still so hot? Yeah, I mean, I don't know. Trust me, bruh. Okay. World War III around the corner. Maybe. I'm not sure. I am taking it as net hawkish. All right, team. Got the Powell rate hike decision coming soon here, guys. Coming soon. Again, the SPY at 420s. SPY at 420s. Pretty sideways. We're approaching that 200 EMA volume weighted average price, and we're kind of chopping back and forth between all of it. Again, we'll see what happens. We'll see what happens, team. Be ready. Again, full press conference streamed live here at 2:30. Everything's flat. You know, we paused, skipped. All right, again, SPY at 420s here, guys. SPY at 420s. Tesla, right about $200 right now, right at $200. What did AMC do today? AMC down to 1013s. Google up a little bit. Q, pretty neutral with the SPY, I'm guessing, but pretty green day all around for all of these. Again, we'll see what Powell says. What Powell says is going to have a big influence here. Solana is blasting off. No hype of what Powell says. Got a feeling. Hey, we'll see. All right, guys, press conference still starts at 20 minutes. Again, we're going to stream the full thing live. Gold. We're watching bonds as well. And again, to understand that market for bonds, right? A lot of people hear bonds. They hear your grandma gives them to you for Christmas or whatever it is, right? Bonds are basically loaning the government money. Treasury bonds specifically are basically loaning the government money, and they pay you a certain yield or interest rate based off of how long of a time you're holding the bonds. Basically, what's called the maturity date. If it's a 10-year bond, you're loaning them money for 10 years. If it's a 20-year bond, you're loaning them money for 20 years, and you get a certain interest rate. The longer term you're loaning them the money, the more interest rate they'll pay. The shorter term they're loaning you the money, the less interest rates they'll generally pay, unless that yield inverts, where shorter term bonds are paying more than longer term bonds. And that's actually the inversion of the yield curve that you hear people talking about a lot as like a really bad economic sign. And that actually happened recently as well, I think. But basically, again, the example I always use, you buy $100,000 worth of the 10-year treasury bonds right now. The 10-year, you can see on TNX, you just move the decimal place over, is paying about 4.8%. So we're just going to round up to 5 to make it easy. So you buy $100K worth of the 10-year right now, and you're going to earn $4,800 a year for loaning the U.S. government that money. And then at the end of that 10-year period, you're going to get your money back. So you're basically going to earn close to 50% over a 10-year period for loaning them money through bonds, right? And the problem, though, is that the S&P 500 will generally pay you more than that. It averages about 10%. But in that regard, it's it's definitely more risky, I'll say, than bonds, because bonds are guaranteed by the U.S. government. So that's bonds right now. Again, that's why we watch bonds, and bonds have a big influence specifically on bond prices. How many bonds the government is buying and selling has an influence on other markets as well. And that's a nuance that you'll see very often in markets. And again, the SPY sitting right around 420. The 10-year is right about 4.8%. PLT is sitting at about 84.50s. Tesla, again, NVIDIA microchips have been pushing up a lot. NVIDIA up a lot today. AMD had earnings yesterday. They are up over $100 right now. They pushed up over 100. They're at 107. So a very big percentage move here for AMD right now. And we'll see if that continues. I thought this was at 2 p.m. So Gambler, the rate hike decision's at 2. The actual press conference about the rate hike decisions at 2:30. So Powell's going to speak at 2:30, but the rate hike decision is always at 2 p.m. Yeah, AMD ripped up. Oil fall. The oil originally spiked because of scarcity potential in the war overseas, but it's since come back down to earth a little bit over the last week and a half. Back on October 20th, it was at 113s, 114s. It's now at 106 for Exxon. So oil, and then we can look at CL. Crude has basically done the same thing. It's dropped some over the last week plus. And so, yeah, we'll see what happens. But you can also watch, again, NVIDIA, Apple, Tesla. I look at the Q a lot. It's a little bit more tech heavy than the SPY, but it gives me a good understanding of what the differences in markets are doing. Q has been pretty green today, though. And again, the last 4 days have been green, but prior to that, the rest of the market was pretty bloody and pretty red, including Tesla and some other stuff. As soon as Powell mentions GDP, this thing is tanking. Maybe. ETH ripping. Well, Bitcoin was ripping earlier today. Bitcoin's starting to rip right now, so the main coins are ripping up right now. ETH is up some too. It's almost 1850. I'm ready for the market to blast. Just looked at the statement release. It's a load of nothingness. Well, it's just telling you what the rate hike decision is. We're not going to know what they think about it until the press conference later in 15. All right, guys. Be ready. Still got over 2,000 people here. Again, slap the subscribe button if you haven't already. Hit the notification bell. I appreciate the love so much. Thank you so much. Check out one of our sponsors while we're waiting. Again, we got 15 minutes. I'm going to preface this plug. with I'm certainly biased in their favor. And I always try to be very honest about sponsors because I'm doing this to make money. Of course, if you were me, you would too. But again, I'm very biased in their favor, of course. But if you want to day trade, and we don't sell a course or service, so like we're gonna have commercials. But if you want to day trade, you can either put up the money yourself. I lost thousands of dollars when I first started trying to day trade stocks, and a lot of people go to like penny stocks. Some people go for like cash accounts. Either way, you're going to be severely restricted. The futures market is the best place to day trade, in my opinion. It's personal subjective opinion, but it's the best way to day trade because there's no PDT rule, and you can get exposure to day trading stocks. Like you can basically trade the SPY and what's called the E-mini. You can trade gold, you can trade currencies to a certain extent. So a lot of Forex traders really should be trading futures in some ways. You can trade the NASDAQ, basically the Q. Patterns are very similar to large caps, but there's no PDT rule. And these funded account programs are cheap ways to test your skill if you don't have that much money. So they give you a demo. The top step is the most legit one in the world. They give you a demo. They test your skill. If you can hit the target on the demo without hitting the max loss and while following their rules, they fund you between $50,000 up to $150K with a 90% split. And so if you're funded, you get to keep 90%. You make 20K, you keep 18,000 of that. They keep 2 cents they're funding you the money. And you also get to keep your first $10,000 in profit. And there's free funding coaches. But if you lose, you're down $49 for the base combine. So it makes a lot of sense if you're learning. Great way to learn with less risk. But again, they are a sponsor of mine. I'm certainly biased in their favor. If you want to check it out, there's the link. Hey, man, thanks for going live with this, man. Hit the subs, guys. Hey, thank you, Chill. I just find it safer to wait until after the questioning, and it still tends to be profitable. Yeah, I mean, I always try to react instead of predict. I get a lot of bold predictors, and usually they're wrong, and then they kind of get mad. Instead of being like, yo, I was wrong, some of them are just toxic and just kind of get weird and mad and end up just kind of sitting around waiting to critique me. In the end, like, people got to get their egos in check. A lot of people are wrong about these things. Like, a lot of people think we're going to raise, and then we pause. A lot of people think we're going to be dovish, and then we're hawkish. A lot of people think we're hawkish, and then we're dovish. In the end, I always try to tell people it's always better, in my opinion, to react to this type of stuff instead of trying to make some big, bold prediction about what they're going to do, especially if the prediction is way outside of the expectations. It's something I always say. And so with big economic reports, I stick to that recipe. I try not to make some big, bold prediction. And I don't mind guessing. But again, I'm very fluid with it and flexible with it. If I'm wrong, I'm wrong. And I think that's how you got to be. Hey, what's up, Ollie B? Yeah, the CME watch tool. We can see what the Feds are expecting now here in terms of next meeting. So again, the next meeting, okay, let's look at December. So here's the December expectation right now for December. About 80% chance of a pause again in December. So about an 80% chance that we're not going to raise rates in December, and about a 20% chance that we're going to raise rates 25 basis points to 5.5 to 5 3/4. Right. So that's basically what the odds are. Only about a 0.1% chance right now. And again, this is before the Fed speech, right? So this is before Big Papa Powell speaks today. And so at this point right now, about a 0.1% chance of a rate cut, 20% chance of a rate hike, and about 80% chance of a pause or skip, a continued skip. Again, what do you guys think we're going to do next meeting? Powell doesn't speak until 2:30, guys. We still got 12 minutes. Yeah, so again, Powell speaks in 12 minutes. All right, looking at markets here. Again, markets pretty sideways on this report. We've moved up a little bit, moved down a little bit. We're still in that range. We drew this range way earlier. And again, look at where we bounced, guys. And so again, support and resistance, identifying ranges can be powerful. It really can. I base a lot of my trades around that type of stuff. And again, we drew this earlier, and then look at exactly where we bounced, literally right off that same level we drew. So we'll see if we keep holding that range. During the meeting, we're almost certainly going to break out of this range. That's the first thing. But maybe once we break out, we'll hold it as, like, if we break underneath it, maybe we'll hold it as resistance. Once we break underneath it, if we break over it, maybe we'll hold it as support on a retest or something like that. That's the type of reactions I look for in markets. But okay, let's put gold up as well. Here's gold. Gold is very flat ahead of this report. Again, we'll see what Powell says. Board of Governors of the Federal Reserve voted unanimously to maintain the interest rate on the reserve balances at 5.4% effective. Yeah, I mean, for sure. Yeah, that's basically a pause daily. Again, it was a pause or skip. They didn't raise rates. Again, it's unlikely that they're going to raise rates in the next meeting for the most part, too, that I'm seeing here. Again, most people think they're going to pause or skip the next meeting, which goes against what the Fed actually said, right? So that actually goes against what the Fed said a couple meetings ago, but it might change once Powell speaks in 10 minutes. So it might change then. All right, guys, 10 minutes, 10 minutes. All right, we're starting to move up. We're at 420s again on the SPY, 420s. See if we can get some trades in real quick before this. We're pretty flat. I'm going to short this and basically bet that we're going to continue down. And this is the futures market, okay? So look, I'm basically shorting the S&P. All right, look, I just made a little quick 25 bucks shorting it. That brings my profit on the day up to about 550 on the day. We got about a 3.5 to 1 win-loss ratio. Again, I'm day trading, scalping this. I'm buying market, sell market. Very similar to day trading stocks. There's just no PDT rule in futures. And so you can use these funded account programs if you don't have that much money. And if you're good enough, you can get funded up to 150K on Top Step. Again, so check them out. Here's the link. Let's get ready. We got 9 minutes here, team. 9 minutes. Hey, guys, just feel we're going to sell down to the end of December. Maybe. I usually gut instinct usually doesn't work in trading, though. Like, people get a lot of the time, confirmation bias is such a powerful thing. You know what I mean? So they over predict things that they want to happen. Maybe from political bias. Like if you watch the news and you hate the current administration, you might want the market to fall. So you can be like, aha, see? Or, taking the opposing side of it. If you're holding a really heavy portfolio and you want the market to go up because your portfolio is going to do well, a lot of the time we tend to over predict what we want to happen, right? And so I try not to go off of gut instincts. I usually take a balanced, reactive approach to this type of stuff instead of some big predicting approach, because I want stocks to go up, of course. Everybody knows here that I'm pretty bullish, but it doesn't mean we are. And so time will tell. Well, yeah, I mean, you can pick whatever brokerage you want. The link is right above you. Powell's not your friend. Well, maybe. Yeah, the gut instincts. I don't go with it. Which do you like better, oil, E-mini, or Nasdaq? I probably go. It depends on what. Again, I have a very specific system in which I build up a cushion on the day first, right? So what you'll see me do is you see me you can see my profit and loss graph from today. I build up a cushion. I take a swing into that cushion. That way, you can see, I build up a cushion of a couple $100, and then I scale up. And if I lose, that's okay because I'm still slightly green. I can take another swing. Once I do that, I scale up some more, take a larger swing. And that way, if I lose, I already have a cushion on the day and I'm back to break even. If I lose when I don't have a cushion, then I just hang it up with a small loss. But if I have a big enough cushion on the day, that gives me the green light to trade larger. And then that's where you get some really big days like $1,000 plus, which don't happen every day. But if you're trying to get funded on one of these funded account programs, that's what you do. That's the way you get funded quickly. Is just by being really disciplined with regards to your risk management system. And again, that risk management system works a lot. If you want to check out Top Step, like I said, link is in the description. But yeah, you could use that not just in futures. You could use it in stocks. Jay Powell mentioned the latest data was negative and he will go hard in the near future. Maybe. All right, guys, press conference starts soon. To 30. Get ready. Yeah, we're going to stream the entire Powell conference as well. Again, I hope he says something positive, but I really don't know. We'll see. All right, team, be ready. Be ready. Again, 5+ minutes. We'll see what he does. Again, we're going to get ready. We're going to have the press conference ready, sitting here, waiting for it. All right, team. You guys ready? Again, we're going to stream the entire thing live right here. Stick around. Market's starting to move up a little bit in anticipation of this. Again, dovish or hawkish? You think Powell's going to fly like a dove, dump like a hawk? My dad's actually a falconer, so I understand that reference. Dive like a hawk is probably what I should say, but still. All right, team. Yeah, we got the video ready live. Let's see how we want to organize this thing here. All right, so we can put this way up here. Put it right there, and then we can put up like... Y'all can hear the music, correct? I also have to swap out my headphones here too. There we go. We can put like the spy gold on the bottom, but mostly the spy. And then make it look even better with like, what do you want to put up? We got the spy gold. We put the Q up maybe. Let's see. Put the Q up right here. All right, team. You guys ready? Let's do this. All right, so we got the Q, the spy. Put that up right there. Let me swap my headphones out real quick. Again, ETH up big at 1840s. Again, 3 minutes, team, 3 minutes. I at jiu-jitsu looking really cool right now. Really tough, you know. Obviously I'm being sarcastic. But which with also GDP being high. Can y'all hear the music? It's really important that y'all let me know. Can you hear the music right now? Apple flying up. Yeah, market's starting to bounce, getting dragged up by specifically Apple breaking highs. Yeah, it looks like mostly Apple. I know Microsoft is up a lot. Nvidia is up a lot as well. Hey, can you hear the music, team? Let me know. Can you hear the music? Yes? Okay, good. I just got to make sure it works so y'all can hear the actual press conference when it goes live too. I might swap these out and put this here. And then put this up here. Does that work, or should I put this a little bit higher so you guys can make sure you catch the full thing? Yeah, I think that works, right? Boom. I think that looks clean, right? We'll even zoom in here so you can fully see it and raise this a little bit more. There we go. And then we'll cut this off right here. There we go. All right, that should be good. All right, team, here we go. Less than a minute, guys. Less than 1 minute. We got Big Papa Powell about to speak. All right, let me pause the music. Prepare the stream. I'm going to mute the sound for a second until it starts. All right. Sitting on hold here, guys. You guys ready? All right, team, get ready. Here we go. FOMC live right now. Starts in 20 seconds. 20 seconds. We're completely live right here. Make sure you hit the live button next to the play button. Make sure you're fully caught up on stream. Will Powell be late today? Let us know what you guys think. The timer's about to go off. We're going to exit out of that. We got 10 seconds here, team. All right, you guys ready? All right, here we go. They got to turn their music off. But here we go. All right, waiting for Powell here, team. Yeah, we did have protesters the last Powell interview a couple weeks ago. It was environmental protesters. SPY's still moving up a little bit. Q moving up. Gold still consolidating. Here he is. What color is this tie? His tie is gray. Ooh, I don't know if that's good.
Good afternoon, everyone. Welcome. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from Other sources like the stronger dollar and lower equity prices could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer term rates that have moved up, they can't simply be a reflection of expected policy moves from us. That we would then, that if we didn't follow through on them, then the rates would come back down. So and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and we're not. I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we have, and that is the way we're going to be going into these future meetings, is to be just determining the extent of any additional further policy tightening that may be appropriate to return inflation to 2% over time.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into the December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial condition situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that the idea that you would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put our recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, I just that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby. Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our 2 mandate goals. We look at that. And we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for 1 additional hike?
I think you're talking about 1 additional.
Yeah,
No, I wouldn't say that at all. I would say, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, that's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, and that is the question. And you're right that in September, we wrote down 1 additional rate hike, but, we'll write down another forecast, as you know, in December.
Chris.
Thank you. Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, is appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation. And we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even. Just thinking that we really, the best thing we can do for the U.S. is to restore price stability, fully restore price stability, and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen it. And I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic. And the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting, a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side, gain that is really helping the economy. And it's part of why GDP is so high, is because we're getting that supply. So we welcome that. But I think those things will run their course, and we're probably still going to be left, we think, and I think, we'll still be left with some ground to cover to get back to full price stability. And that's where monetary policy and what we do with demand is still going to be important.
Against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do, if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plots out the window, that every meeting is live with the possibility of a rate increase for right now. Doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people in the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is, what's potential growth this year? People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential. And that means that if you could be growing at 2% this year, and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about the meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
I mean, I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think one or two additional hikes. So you're close to the end of the cycle. That was an impression as of a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up. And QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not, I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
Got him.
Janelle Marte with Bloomberg. So in addition to persistence, when you look at long-term treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but there are a few of the common ones that people look at, and so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture, and they do play a role, of course, in many of the major standard financial condition indexes. Your second question was. banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the March, the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And, this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the twos, and the year after that further into the twos. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question. about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the UM thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable. And so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think years from now, economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, and ultimately we've got to look at the effects of that policy is having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, they have wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation. so far. Although I think I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is clear. I think clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is, well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think we want to see that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation, with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic has been, and also at the same time, the pandemic effects are wearing off, so that goods availability, automobile availability is better, or was better. I think it still is. and from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. That took longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So Daniel, for the last question.
Thank you, Chair Powell. Daniel Avis from Agence France Presse. Just a quick question following up on an earlier one with regards to the Israel-Hamas conflict. The Fed's financial stability report said that Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say, so, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take really important notice of, but it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. War in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you.
Thank you.
Thanks very much.
Okay, guys, so that is Powell today. Stick around. We are going to trade a little bit because it is power hour right now. Mostly got dovish reactions to Powell today. Let me know what you guys think about it. Mostly got dovish reactions. The market responded positively. And again, that was my guess, is that a huge theme of the market, like a lot of people, when you see, and a lot of the times they're just new traders, right? They're new, where they got their ego in the way, or they want to make some big, bold prediction, right? But one of the common themes of markets in general, not just the stock market, all markets, is balance. Okay. Balance, especially economic wise, is incredibly important for both the Fed, for the banks, for the analysts, or maybe not the analysts, but balance is incredibly important. And so every big meeting, you got people who try to somehow predict the lowest probability thing out there, like a rate hike today or a rate cut today, and they're always wrong. And again, once you start to really understand that balance is key, everything doesn't have to be this big shocking moment. You don't have to make some crazy big bold prediction and get it right and applause rains from the sky. Like, it doesn't need to be that. Like, you have to understand balance is generally what happens. In the market, a lot of the time you got these two different groups. You got either completely like we're going to break highs. Tomorrow we're going to break highs and shoot up, or we're going to crash and burn today. And very rarely is it ever like that. Most of the time it's somewhere in the middle. And once you start to recognize that, and you really recognize it when you watch these meetings over and over again, once you start to recognize that, trading markets become a lot easier. And that's something that you have to understand. Like, balance is important. The market's pushed down a lot. We have Apple earnings tomorrow. Market's pushing up today. So balance is key, and it's important to understand. With that said, though, guys, if we're going to get ready to trade some, we're trading on our sponsor, Top Step. This is a platform called Quant Tower. It's a trading view indicator service. This is a funded account program in futures. where you can trade the NASDAQ. I can basically trade the SPY in what's called the E-mini. You know, you can see the price action is the same with big bounce, you know, big bounce, same price action, but there's no PDT rule. We're pushing highs a little bit too much. There's no PDT rule in futures. I can day trade short. You can see I can buy market, sell market, buy bid, sell the ask, just like stocks, but there's no PDT rule. And again, I can day trade the S&P or the NASDAQ. I can't trade actual stocks, but I can trade the index funds that are comprised of those stocks. And the patterns are very similar. What Top Step does is they give you a demo and they test your skill. It's a challenge. It's only $49 for the base one. And if you could pass that challenge, if you could take that 50K demo and make 3K in profit without losing over 2K, they fund you 50K with a 90% split. And so if you get funded, you make 10K, you get to keep 9 of that. They get to keep 1 since they're funding you that money, and you get to keep your first $10,000 in profit as well. They're the most legit one in the world. They pay out millions every year in actual withdrawals. They fund thousands of traders a year. It's a great way to test your skill if you're not ready to put the money up yourself, or maybe you don't have that much equity and you want a cheaper entry. This is another option for that as well. I can't guarantee you're going to make money. They are certainly a sponsor of mine, and so I'm biased in their favor because they pay me money. But if you want to check it out, here's the link. Market is bouncing up again. We'll look for a little pullback here if we can take some trades. We'll look for a little pullback. The market closes at about 25 minutes or so, about 25 minutes. And so, yeah, fun stream here, guys. Fun stream. We'll see what the market does. Hey, listen, guys, we need 40 subscribers. We need 40 subs right now. Just 40 little baby subs right now, guys, to break 117,000 subscribers. Again, we need a little 40 subscribers right now, guys. Right now alone, we've got 1,800 people here. Subscribe. I'm not going to say I'll hate you forever, but I'll hate you forever if you don't subscribe. Right now, do it now. I appreciate the love, guys. Thanks so much. Yeah, I certainly, you know, again, that's an affiliate link. I earn a commission, you know, if you sign up. If you lose in the demo, you lose your $49, and you can always reset it for the, you know, for the same amount and just start over. All right, so we got a little pullback here. Again, here's the E-mini. I'm going to buy this dip and see if we continue, but we might be a little extended here. Luckily, we've got a really nice cushion on the day, and so I can take a couple contracts here and see if we pop up quickly. All right, we're flat. We're going to take half of that off there, lock that in. We're up another 50. We'll go ahead and lock the rest of that in. So we just earned a little bit more. We're up about 60. We're up about 570 on the day or so, 570. All right, we got another little dip. I'm going to go ahead and buy this again, see if we get a pop back up. All right, so we're buying one contract of the regular E-mini. Again, we got a nice little cushion on the day, so we can either add to this if it dips too much, or we could just sit on it. I don't know what I want to do yet. Depends on how fast and what the price actually. So we're up about 40. Go ahead and cut that. Got out of that one. So now you can see, guys, on the day we're up about 600. You know, we just made another $40. We're running about a 4-to-1 win-loss ratio. And again, my strategies with this are very simple. Very simple. I always try to build up a cushion. And if I could build up a cushion of a couple $100, you can see my P&L for the day on these funded account programs. Like, I built up the cushion. We made $200, but $200 we lost. We scaled back up, took some more swings, and then eventually it stuck. Even when we lost right here, you can see after losing, we were down. We're still green, almost $100 still. So we build up a cushion, take larger risks once we have the cushion. If we don't have a cushion, we take much smaller size, much less risk. And if we end up losing without a cushion, we just kind of shut it down with a small loss. And what that enables me to do is have big wins, big winning days, small losing days. And you can kind of rinse and repeat and scale that system to where it can be pretty powerful. Anyways, we got a little pullback here. Yeah, I'm trading the regular E-mini. Yeah, again, I can't guarantee anything. Don't want you to copy me. I have no idea what I'm talking about. I might be wildly wrong about anything and everything. Appreciate the love. You can also give me a follow on Twitter at Beginner Trades is my Twitter handle, at Beginner Trades. We cover all this big news. We cover the FOMC rate hike decisions, all that good stuff there as well. All right, so we got this little pullback bounce. Right now, this is the trend I see. And again, the market closes in about 30. But again, this is the trend I currently see right now. That's the trend, I think. No? Anonymous, man, you just, no offense, bro. I'm not saying you're a scammer, Anonymous, but you sound a lot like one. You're trying to like get people to message you outside of the stream. And, honestly, I've been watching Catfish a lot. And like, what you'll notice, like I've been watching this YouTube channel called Catfished, right? And like, they're basically convincing mostly like baby boomers, that they're in some relationship with this really pretty girl or really like handsome dude. And they're basically convincing them that in a relationship, and then sneaking in, hey man, I need to buy food, can you send me $100 worth of gift cards? And they just kind of rinse and milk that from what it's worth. And the people are so like mesmerized by how pretty the girl or how handsome the dude is, that they just kind of send these scammers money, right? But honestly, when you really think about it, like the people doing this have got to be like the worst people in the world. Like I get it, they might not have any skills or ways to make money, but like just pretending to be somebody's girlfriend and then just scamming them just seems like a terrible thing to do to somebody. Like I don't, just terrible. I feel for some of these people. I feel for some of them. Again, others, I'm just kind of like, y'all are dumb, man. There's some people that are just, they're just, you can tell they're just not super smart. All right, we're gonna buy this here. We got a little cushion on the day. But yeah, you can tell some of them are just not the smartest people, The person's like, hey, I need to have money for rent. Send me $1,000. And they're like, well, hey, why don't you just get me in touch with, your apartment complex? Like, I'll pay it for you. And they're like, no, they don't have a phone. And it's like, your apartment complex doesn't have a phone? No. And they just kind of keep on doing it. All right, guys. So again, we're in the E-mini right now talking about dumb. Let's see if I lose this trade. In the end, don't send anybody randomly money. Most of the time, they're scammers overseas. All right, so again, we're in one trade, 2 contracts flat right now. Here we go, popping up. Just took half off. Just locked in. We just made about another $100. Scalping this move, buying at the bottom of that trend line we drew. We are now up about 700 on the day. We got about a 4.5 to 1 win-loss ratio. We're up 692.50 right now, 692.50. So this is called Top Step. Brittany. So this is called Top Step. It's a funded account program. The platform I'm using is called Quant Tower. If you want to check out the link, here it is right here. Do you know any platforms that use IB for their upstream? No, not really. I use TD for stocks. Yeah, if you're trying to date anybody online, guys, if you're trying to date anybody online, have them face chat with you, FaceTime with you. Have them like video call you, and if it's like a minute long and they run into lag, they're probably pulling some other video off the internet and just sticking it in front of you, hoping that you're not smart enough to put 2 and 2 together and recognize that they're just going to throw in some old random clip of somebody else up there, unless they say your name directly and you can see their lips moving. But honestly, even that's kind of risky because AI has gotten really, really good at this point in time, like genuinely good. You can see a bunch of fake Elons going around there. All right, guys. Hey, market's popping up a little bit. I'm pretty sure you could use it in Canada. I would reach out to them. They're a sponsor of mine. Top Step's a sponsor. You can check out the link in the description. I'm pretty sure you could use it in Canada, but I'm not 100% sure. So again, really not. Platforms like this, like indicators, like premium indicators, until I actually tried these guys out. And when I tried them out, like you'll see how useful they are. Like check this out, right? So this is a company called Chart Prime. It's a trading view indicator service. So you can use it in stocks, crypto, Forex, futures. They got a bunch of different tools that you can use. One of them, I like using the E-mini. So I'm going to put the E-mini up instead. All right, so again, there's a lot of different ones. It's custom trading view indicators, so you can use it in stocks, crypto, Forex, futures. So you can use it on basically whatever, Tesla, Apple, whatever you want to use, really, right? But like, look at how accurate this can be. Look, strong buy signal here, and then look at the beautiful bounce you get afterwards. Sell signal here, nice drops. Buy signal way down here at the bottom, beautiful bounce. Strong sell signal there. You got like 30 minutes of drops. This one might have been wrong, but they're not always going to be right? This one works. So I would say like what? This was like 4 out of 6 worked. Again, the ones that I find that have really crazy high accuracy are, and again, I can't guarantee you're going to make money. They're a sponsor of mine again. So again, I'm biased, of course, because they pay me money. So naturally I'm going to be biased. And I always try to stay pretty transparent about that. But the ones that I find to be crazy accurate. Okay, we need 11 subscribers left, 11 subs left to hit 117K. So we're going to hit that right now. But again, the ones that are genuinely accurate. Okay, so we're going to give you one basic one, but it's when you get an engulfing candle and a reversal signal that happen right on top of each other like this. You can see it happen here, and then you got like 15 minutes of bearish action. But that's honestly one that like you could consider working or didn't work. But like, look, like let me go back and show you the accuracy of this. Like, let's just back test it over the last like week or two. Right. And so look, reversal up, bullish engulfing candle, beautiful bounce afterwards. So again, when you get an engulfing candle and a reversal signal on chart prime within, I would say 4 candles, so 20 minutes of each other, powerful accuracy, right? So that's one. Let's keep going back. Keep going back. You need them right on top of each other. You know, here's one that bounced a little bit, but even if you say that one failed, right? Like, look, like watch. You got to find one right on top of each other. And you can set alerts here too. Okay, so look, here's one. It's not going to happen every day, but you can get like phone alerts. Look, beautiful bounce after it happened. Again, we'll keep going back. Look, same thing here. Beautiful bounce. Let's look for another one. Some days you'll get like a lot that show up at once. Same thing here. A reversal up, bullish engulfing. Beautiful bounce. Let's find another one. Look, when they're right on top of each other, same thing. Reversal up, bullish engulfing candle. Beautiful bounce. Over like, this is like, to put it into perspective, this is like 4 hours of bullish action after it happened too. So I can't fake what I'm showing you. Again, I can't guarantee it's going to work every time either. But again, I challenge you to back test it yourself. And this is just a small piece. Look, bullish engulfing, reversal down. Nice little drop afterwards. Again, I challenge you to back test it. Look, bullish hammer. Oh, that's a hammer candle. We need an engulfing candle. Oh, this is the SPY again too. The E-mini is what I like better. Watch how accurate it is on the actual E-mini futures contract. So a lot of the time I look at these on both futures and stocks, but the E-mini is the one that actually works well. I thought we were on the E-mini. The SPY, for whatever reason, it's just slightly off, but the futures contract of the E-mini, it works genuinely well. Like, look, yeah, so we only had one today so far. It was a downside one, but look, engulfing candle, reversal signal right on top of each other, beautiful drops. And this was like a drop from 6 to 10:30. So for hours and hours of drops afterwards. Again, I'll go back just a couple days to show you guys some more. Look, bullish engulfing, reversal up signal right here. Bullish, beautiful bounce. Drop here from the same thing. Again, so that's 3 for 3. Let's keep looking. Keep looking. Look, 4 for 4. 5 for 5. Even that one might be, but you could even say that one's failed. So we even call that one a failure. So 5 out of 6. The bullish engulfing, reversal up. If they happen right on top of each other, and again, you can set alerts, they can be powerful. This is just a small piece of what they offer. Like, look, I can go back and put on chart patterns. I can put up smart money concepts, oscillators, market dynamics, like all these different tools that you can use. And it's like, if you get 40% off, I think it's like $50 a month if you use my link. Like $50 a month, and you can see oscillators. I can put up like, you'll see like flag patterns and wedges and like all these different things that are pretty cool. I can put up like an hourly time frame as well. So I've been using them a lot. We're still in that trend that we drew. If you want to check them out, again, they're called Chart Prime. I'll put the link up. Of course, though, I can't guarantee you're going to make money. Nobody can, but yeah, I mean, CP, you know, it's fine to talk about sponsors, but if that's all you ever talk about and you're just kind of trying to troll me about my sponsors, you know, I'm gonna put you in timeout a little bit. Chill out. Hey, congrats, great. That's great, dude. Just want to know what futures chart we are watching. So this is the S&P 500 futures contract. It's called the E-mini. Yeah, thank you, Funny. I missed out that the E-mini is the one where I find it's powerful, right? Now, I challenge you to back test some of them yourself. You can find some pretty good edge in some of them, I think. Never tried it on Bitcoin. I could look it up. Again, I'm not really much of a like Bitcoin trader, but I can look it up if you want to see it. Let me see. Bitcoin's a little bit less liquid, though, is the problem. It's like Bitcoin's a little bit less liquid. Let me see. I think it was actually designed for crypto. The problem is you don't get many engulfing candles on Bitcoin, you know? So like you got one here and it seems to work, but it's hard to tell. Look, reversal, bearish engulfing drops. You just don't get many engulfing candles. Like you got some here and you get dips afterwards. You got some here. That one might not have worked. But look, reversal down, bearish engulfing. Dips, that one worked. So yeah, it looks like it could. This one worked, bullish engulfing, reversal up. Look, right on top of each other. I'm telling you, if they're right on top of each other, the accuracy's got to be like crazy high. Again, I don't know. I would test it yourself, but from my testing, it looks pretty solid. All right, so again, the E-mini still in this trend. We've already made 700 on the day, though. I just don't know if I want to test it too much. I like indexes more, Justin, but everybody's different. This is the E-mini S&P 500 future contracts. Yeah, I'm not doing. I'm not streaming PayPal earnings. We got PayPal and Airbnb. All right, team. I'm probably just gonna go ahead and close it down. And so interesting FOMC meeting for sure. Pretty good results from it. And again, we'll see if this E-mini trend continues. Again, you can kind of see I'm drawing the trend. This is Quant Tower is the platform I'm using. It's called Quant Tower. Not quite the best. That looks a little bit better. But yeah, we're definitely in this trend right now. Let's see if we hold it. What do you guys think? Will we hold this trend? Let me know. I'm gonna go ahead and get out of here. Y'all be safe. Nah, I'm not gonna stream PayPal streams. A PayPal stream. It's just not big enough for me to worry about, I think. So yeah, I just don't know if it's big enough for me to truly worry about. But again, we'll see. Y'all be safe. We'll watch it for sure. I'm just probably not going to stream it. I'm tired, man. We got Apple tomorrow. It's been really busy, and it's been great. Like, we got like 40,000 views in the last 48 hours of my channel, which is great. We're averaging like 20,000 hits a day, but I'm tired, man. We've been streaming a lot. You know, we had AMD earnings yesterday evening. Tomorrow we've got jobless claims numbers and something else. Yeah, so again, tomorrow we got jobless claims, non-farm productivity. Is that it? Jobless claims and non-farm productivity. We got the Bank of England rate decision. Do we have earnings tomorrow morning? I know we have Apple tomorrow evening. We got Palantir earnings early in the morning, and then jobless claims, Shopify, Eli Lilly, and some other Starbucks, Moderna in the morning, and KLA, Penn Gaming. So all right, team. Hey, good to see you, Tiny. Hope you guys doing well. But yeah, I'm gonna bow out today, guys. Y'all be safe. Love you all. Be good. I'll see you guys tomorrow bright and early.